Good afternoon, everyone. We start off the show with a look at the stimulus that President Biden signed, the $1.9 trillion COVID relief bill yesterday, of course. Stimulus checks, though, could also start coming in for those eligible in just a few days. So how is this going to affect consumer spending? Here to discuss is CEO of Opportunity Financial. It's a fintech company that focuses on middle income and credit challenged consumers. It's Jared Kaplan. Also, Bloomberg's Wall Street reporter, Sonali Basak. A big thank you to both of you for being here. Hey, Jared, unemployment rising last year as the pandemic forced people indoors. How did this affect people's abilities to keep up with bills? How did credit scores change?
Yeah, when the pandemic hit, from our customer base, we saw when that stimulus check hit the bank account, they had a lot more money than they typically would. We're serving the 60 million that are locked out of traditional credit. And on a good day, it's $300 in the bank account. When the stimulus check hit, we saw that rise, 3-4-fold, but very quickly it came down. It only took about 8 weeks for that stimulus to burn off and go back to $300 in a time when everyone was quarantined and not spending money. So that repayment of debt, which some of that funds were sent to, actually increased credit scores over the time period. Unfortunately, credit access did not improve.
Yeah, what were people paying? What were people paying off? Do you know?
Yeah, no, absolutely. When you're flush with more cash than you had, and you're not, going on vacation, going to the restaurant, you're not driving your car so you can't break it, you're not going to the doctor unless you think you have COVID. You're prudent with it. You pay down debt. You pay down high cost debt. So we definitely saw consumers pay down debt at increased rates that you would expect, and the subsequent impact of that is credit scores go up.
Well, there's such a big fear across Wall Street right now that the stimulus might be too big, that people will get too much money and spend too much in the economy, even with all the pain that we're seeing now. What do you say to people who believe that?
Yeah, so we saw that first stimulus check burn off, right? And at the end of the year, customers actually had less money in their bank accounts than they did in 2019 and in 2018. Then you had the $600 check hit, end of the year, early January, we saw a little pop. But that took less than 2 weeks to go back to where we are today, which is at this moment today, for our applicants, we're seeing less money in the bank account than they did the prior 3 years. So there's no question that they need the money. The real question is when it hits, right, it's a bigger check, it's a little bit more generous to dependents. Now with the economy reopening, with people driving their car again, going to the doctor, all this pent up spend, the thought is it will evaporate probably more quickly than it did last year, and the issue will still remain.
So
how are they going to get credit access?
You mentioned tougher access to credit. Last year, when you talked to the banks, they were trying to be kind to their consumers, make it easy for anybody that needed money, small businesses, consumers. I'm worried that maybe the honeymoon is over. I'm worried if when you look around, it's even harder for consumers today than it was even a year ago because there was so many credit needs for the last 12 months.
Yeah, I think the traditional banks just don't trust the traditional credit score like they used to. And therefore, they had tightened during this entire period. We haven't seen that loosen at all. And even though credit scores as a whole are higher, we don't think that credit access is going to be greater. In fact, we think it will be less.
This bill that the president signed yesterday, that he talked about last night in his address to the American people at 8 o'clock, it has so much more, Jared, in it than those stimulus checks. I'm wondering what you think of the other elements of the bill and how they are going to help address inequality in this country. I mean, we're talking child tax credit here, expansion, $360 billion to state and local governments, $300 per week for unemployment extended all the way until September 6th, more money for schools. What do you make of it?
There's a dearth of savings in the country. Some stats would say 80% of folks are living paycheck to paycheck. And unless those staples change, unless income goes up and the cost of living, right, education, healthcare, childcare, housing, those go down, it's going to be tough for people to save money. I think people don't understand the median U.S. customer is really struggling. And if you have less than a 620 FICO score, you're typically locked out. So some of those factors that you talked about, I think will help. I think they will provide some cushion. But we're talking about a couple $100s in the bank account. So that's still not much. And That's why access to credit is important. Even if some of these aspects of the bill help the cushion, especially that child care, the payments for child care over a period of time, which has a sunsetting provision, but there is talk that will be permanent over time. I mean, these are great things for the folks, but there's still a long way to go to get people what would be considered healthy.
So you mentioned credit scores earlier. There's a lot of talk among the banks about how an over-reliance on a credit score really can exacerbate inequality in a lot of ways. And also now in this new era, as we come out of the pandemic, you see it in the numbers, right? That Black small business owners have had a hard time getting access to credit. Black unemployment rate is even higher than the white unemployment rate. So, what are you seeing in terms of inequality here as we start to recover and the access to money changes?
Yeah, what we know is, and that's 60 million that's locked up. That's not my number, right? That's the New York Fed's number. They did a great study in September of 2019. But that traditional credit score it doesn't really tell you two things that are important: someone's ability to repay and someone's willingness to repay. And if you're able to understand those two elements, you actually can provide credit to people that don't look necessarily creditworthy from a traditional credit score perspective, but they will pay you back. And that's where it's got to change. And that goes across all races, ethnicities. There's certainly an inequality problem. We have to change that. And it starts with figuring out creditworthiness from another metric besides just the traditional credit score.